Welcome back to the ProTicker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
And it is certainly a morning where we need to talk because looking at the screens today, there is just an absolute sea of red ink out there.
You can say that again. It is Wednesday, February 4, 2026. And I think a lot of people woke up expecting, a relief rally. Former president and now president again. Trump finally signed that funding deal.
Right.
The 4-day partial government shutdown is officially over.
And usually that's the all-clear signal. Government opens back up, the national parks unlock their gates, federal checks go out.
And the markets breathe a massive sigh of relief.
Exactly. Uncertainty removed, stocks go up. That's the standard textbook playbook.
But that is definitely not what is happening today. The textbook has apparently been thrown out the window.
It has.
Instead, we are looking at what can only be described as turmoil across global markets. And that is exactly what our mission is for this deep dive. We are going to investigate why good earnings apparently aren't good enough anymore. Why software stocks are facing what some people are calling an existential crisis, and why commodities, stuff like gold and copper, are on a complete roller coaster ride.
It's a classic case of good news is bad news, but with a very specific, very modern twist involving artificial intelligence.
Exactly. And to get to the bottom of this, we have pulled together a massive stack of fresh reports. We are looking at breaking analysis from CNBC, Bloomberg, Reuters, and Yahoo Finance.
And we're going to need all of them to make sense of this because the signals are incredibly messy right now.
So let's tease what's coming. We're going to talk about a term that I have to admit terrified me when I read it this morning in a Bloomberg report, the SOSPocalypse.
It's a catchy name for a scary trend. It basically questions whether the software industry as we know it, that whole subscription model, is dying.
We're also talking about an AI lawyer that is scaring the living daylights out of investors. And we'll look at why a pharmaceutical giant, the company behind Wegovy, lost nearly 18% of its value overnight.
A massive drop.
But let's start with that tech wreck. SOSPocalypse. For those listening who might not live inside the Silicon Valley bubble, SaaS stands for software as a service.
Right. It's that model where you pay a monthly subscription for pretty much everything, from email to your accounting tools.
It's been the golden business model for, the last 15 years?
Oh, easily. Recurring revenue. Wall Street loves it because it's predictable. You sign up a customer, they pay you forever. Simple.
But today, that model is under siege. This was the lead story in Bloomberg. What on earth is going on here?
It sounds dramatic, but it reflects a very real, very sudden shift in investor psychology. For the last couple of years, the narrative has been that AI is a tool. It's a helper.
Right.
You use software, and AI makes that software better. It makes you faster.
Co-pilots, assistants, we've heard all the
Right.
buzzwords. I pay for my software, and maybe I pay a little extra for the AI feature. Microsoft Copilot, for example.
Exactly. That was the AI augmentation thesis. Humans plus AI equals better work. But this week, the narrative shifted violently. The fear now is AI substitution.
The idea that AI won't just improve the software you subscribe to, it will replace the need for you to subscribe to it at all. And the catalyst for this specific sell-off was a launch by Anthropic.
Anthropic, the makers of the Claude chatbot, a big rival to OpenAI.
That's the one. They launched a new product called Cowork. It's a plugin, specifically a productivity tool, but it has these incredible capabilities for legal drafting and analysis.
Okay, play devil's advocate for me here. New tools come out all the time. Why did this one specific tool cause so much damage to the market?
It's what the tool represents. It's about the seat license. Think about how these companies make money. Salesforce, Intuit, Adobe, they charge per seat, per human user.
Okay.
If Anthropic's tool can autonomously draft legal contracts, analyze bank statements, file taxes,
Yeah.
all without a human guiding every single click.
You don't need as many junior lawyers or accountants.
Exactly. And if you don't need the humans...
You don't need the seat licenses. You don't need the seat licenses. That is the terror. If a law firm fires 30% of its junior associates because Claude Cowork does the drafting, that law firm cancels 30% of its software subscriptions.
Wow.
And when you look at the market reaction, it was swift and brutal. We saw Salesforce, ServiceNow, Adobe, and Intuit all drop around 7% or more.
Intuit dropping 7%. That's the TurboTax and QuickBooks people. So the fear is I don't need QuickBooks if Claude can just look at my bank account and do my taxes for me.
Precisely. If an AI agent can do the work, why pay for the interface? And this wasn't just a US phenomenon. Reuters pointed out this spread globally very fast.
Really?
Oh, yeah. In Japan, a company called TI's plunged more than 15%. Trend Micro was down. In Europe, SAP, the biggest software company there, the backbone of European business, it dropped over 3%.
It's truly a global contagion. I was reading a quote in that Bloomberg source from Jeffrey Favuza over at Jefferies. He didn't mince words.
No, he didn't.
He described this suspocalypse fear as investors worrying that software is the next print media or department stores.
That is a haunting comparison. Think about what happened to newspapers when the internet really took off. The content didn't disappear. People still read news. But the business model of selling physical papers was just decimated.
Right.
Favuza is capturing that anxiety, that the subscription model itself might be the newspaper of the 2020s.
But is everyone buying this doomsday scenario? I mean, markets do tend to overreact. I saw CNBC mention Jim Cramer had a different take. He did. Cramer, who actually has a law degree, made a valid point about friction. He said that while Wall Street is freaking out about this Anthropic legal tool, actual lawyers might not be ready to trust their careers to a chatbot just yet. There's a trust gap.
That makes sense. I wouldn't want a robot defending me in court just yet. I'd want a human to at least check the work.
Exactly. And compliance departments are notoriously slow. But here's the thing. In the short term, the market doesn't care about what lawyers think today.
It cares about revenue in 2027. Right. They care about what happens to revenue in 2027 or 2028. And right now, the fear is that AI disruption is eating SaaS growth. They are repricing these stocks for a future with fewer customers.
Okay, let's unpack the other side of the AI coin. Usually when software falls, the hardware makers, the chip companies rally.
That's the standard logic.
Because even if the software model changes, you still need the chips to run the AI, right? They're selling the shovels for the gold rush.
If AI usage goes up, chip demand goes up. That's the play.
But that didn't happen this time.
No, it didn't. And this brings us to that priced for perfection problem we've touched on before. It's a different kind of anxiety.
We're talking about AMD here. They released their Q4 results.
Right, and if you just look at the raw numbers, they were objectively good. Their data center revenue, which is the AI proxy everyone watches, that's where they sell the big AI chips like the MI300.
That's the key metric.
It is, and it came in at $5.4 billion.
Which beat expectations. The forecast was $4.97 billion, so they beat it by almost $500 million. In any normal world, that's a champagne-popping moment.
A significant beat. And yet, look at the stock. It fell about 1.7% in the aftermath.
Why? If I beat my performance review at work by 10%, I expect a raise, not a pay cut.
The stock market is a cruel boss. The issue is this AI bubble anxiety. The expectations are so incredibly high that just beating isn't enough anymore. You have to blow the doors off.
So it's not good enough to be good.
No. Investors are looking for exponential, explosive growth. A solid beat feels like a disappointment because the stock price had already run up, assuming a miracle.
That's a classic sell the news event. Everyone bought the stock expecting the beat, and when it happened, they just cashed out.
Exactly. And this nervousness is contagious. It's not just about AMD, it's about the sustainability of this entire AI hardware boom.
That makes me nervous for Google. Alphabet is set to report earnings post-market today, Wednesday.
It's going to be a massive test. Yahoo Finance had some great data on this. Analysts are expecting Alphabet's revenue to climb 15% to $111.4 billion.
That is a staggering amount of money for one quarter. $111 billion. That's the GDP of a mid-sized country.
It is. And there is so much optimism baked into that number. There's buzz about their Gemini 3 model, which reports say caused a code red panic over at OpenAI because it's so good.
Right.
And this landmark deal they supposedly have with Apple.
Right, cementing their place on the iPhone. That's their moat.
Exactly.
Okay.
But the AMD story tells us something dangerous. The question remains, if Google comes in at $111.4 billion exactly, or even $112 billion, will the market treat them like AMD?
If they don't deliver absolute perfection, we could see another sell-off.
The bar is set at miracle.
It feels like walking a tightrope. One slip and you plummet. And speaking of plummeting, we have to talk about Novo Nordisk. This is the Danish pharmaceutical company that basically owns the weight loss conversation with Wegovy and Ozempic.
They do, or at least they have for the last couple of years. They were the undisputed kings of that sector.
And yet they cratered. Depending on which exchange you look at, shares were down anywhere from 14 to 18% overnight. That is a massive move for a company that size. What happened? Did the drug stop working?
No, the drugs were fine. The business model's hitting a wall. It was a shock guidance release.
This is a surprise.
A huge one. Usually, companies try to soften the blow, use gentle language, but CEO Mike Dowstar was brutally honest. He literally said, it will get worse before it gets better.
You never want to hear a CEO say that. That's usually what you say right before a major restructuring.
No, it's alarming. He warned that sales and profit growth are going to drop in 2026. The reason is twofold: increasing competition.
Eli Lilly?
We know Eli Lilly is aggressive with Zepbound and pricing headwinds.
I want to drill down on pricing headwinds. That sounds like corporate speak for, we have to lower our prices.
That's exactly what it is. For a long time, Novo Nordisk could charge whatever they wanted because demand was infinite and supply was low. But now you've got insurance companies, governments, and competitors all putting pressure on those high prices.
So the monopoly is ending.
The monopoly era for weight loss drugs is ending. They have to sell more volume just to make the same amount of money.
So the easy money is gone. Is there any good news for them? Or is the party just over?
There is a silver lining, which the experts pointed out. They have these new pill forms of Wegovy, and higher doses just got approved in the UK.
Oh, that's interesting.
The long-term thesis is that oral pills are much easier to sell and manufacture than injections.
Makes sense. Most people would rather swallow a pill than stick themselves with a needle every week.
Correct. But the market is very short-sighted. They see a growth slowdown in 2026, and they are hitting the eject button now. They don't want to wait around for the pills to save the day.
It really seems like no sector is safe today. Tech is down because of AI replacement. Chips are wobbly because expectations are too high. Pharma is crashing. So usually when stocks are scary, the old wisdom says, buy gold. But I'm looking at the commodities section of our source stack, expecting to see green. And it's a mess, too.
Mess is the right word. If you thought stocks were volatile, look at the metals market. It defies the old logic.
I saw a headline about silver having its worst day since 1980.
Yes, it plunged 30% in a single day. Reason?
30%. That's not a dip. That's a collapse.
Yeah.
That's crypto-level volatility.
It is historic volatility for a physical asset. Now, it is rebounding. It's up about 5 to 8% today. But that kind of swing shakes people out of the market.
Yeah.
And gold, the ultimate safe haven, fell nearly 10% recently, though it's climbing back now.
So why is the safe haven acting like a risky tech stock?
Yeah.
Usually turmoil makes gold go up.
It connects back to the Federal Reserve and the perception of stability. CNBC had some great reporting connecting the sell-off to the nomination of Kevin Warsh for Fed chair.
Warsh is a well-known name in financial circles, former Fed governor.
He is.
Yeah.
And the markets view him as a safe pick, someone who is competent and, crucially, will secure the Fed's independence from political pressure.
Ah, I see. So the logic is, if the Fed is in safe hands, the dollar is safe.
Right.
If the dollar is safe, I don't need to hoard gold bars in my basement to protect myself from the collapse of the currency.
Exactly. The fear premium evaporated. Gold often trades on the fear that the central bank will mess up. When investors feel the central bank is stable, the urgency to hold gold diminishes. That triggered the sell-off.
So it's a vote of confidence in the U.S. financial system, which paradoxically causes gold to crash.
It's fascinating, isn't it?
That is fascinating. So gold is down because people are less scared about the dollar. What about copper? They call it Dr. Copper because it diagnoses the health of the economy. Is the patient healthy?
Copper is telling us a very confusing story right now. It's diagnosing a split personality global economy. According to Bloomberg, it hit a record high over $14,500 a ton and then immediately slipped back.
Why the schizophrenia?
Conflicting signal from China. On one hand, you have strategic stockpiling. The government and industry groups in China are buying copper aggressively to put in reserves.
And that drives the price up?
Artificially, yes. But here's the catch. The actual fabricators, the people who make wires and pipes for buildings, are seeing soft demand.
So the government is buying, but the real economy isn't using it.
Precisely. And stocks in LME warehouses, that's the London Metal Exchange, are jumping up in Asia. That means the metal is being produced, but it's just sitting there. It's not turning into houses or electronics.
That suggests the global economy might be weaker than the copper price suggests. But there was one other detail in the copper story that I found fascinating, involving the U.S.
Was this the Africa deal?
Yes. A group called Orion CMC agreed to buy stakes in African copper mines from Glencore.
Glencore, the massive mining giant.
Right. But Orion CNC isn't just a random private equity firm. It is backed by the U.S. government.
Interesting. So this is the U.S. government basically acting like a venture capitalist to secure a supply chain.
It's the race for critical minerals. We aren't just leaving it to the free market anymore. The U.S. wants to ensure it has access to the copper needed for EVs and data centers, and they are backing these deals directly.
To compete with China's influence in Africa.
Exactly. It really shows how strategic these metals have become. It's not just a commodity, it's national security.
That is a perfect segue to our final segment, geopolitics and trade, because the government is definitely getting its hands dirty there.
It sure is. The line between business and politics is basically gone. We have breaking news about a trade deal between the U.S. and India. President Trump has signed it.
This is a significant development. The headline numbers are that U.S. tariffs on Indian exports are dropping from 25% down to 18%.
That's a nice cut for Indian exporters. Makes their goods cheaper here.
It is. And in return, India has pledged to purchase $500 billion worth of U.S. goods.
$500 billion.
We're talking agriculture, tech, energy. It's a massive commitment that helps reduce the trade deficit.
But, as always with these things, there is a catch, or at least a controversy, and it involves Russia.
The Russian oil friction point. This is where the reporting gets really interesting and where the narratives diverge. Trump publicly claimed that as part of this deal, India agreed to stop buying Russian oil.
Which would be a huge blow to Putin,
Yeah.
because India has been one of his biggest customers since the sanctions started.
Huge. That oil money fuels the war machine. But immediately after Trump said that, Moscow came out and said, India never said that.
Oh boy.
And even Indian officials quietly, through back channels, are saying, we didn't agree to that.
So we have the U.S. president saying one thing and the other party saying another. What is actually happening? Is India stopping the oil buys or not?
It's a balancing act. The expert analysis from our sources suggests India is trying to thread a very small needle. They want the economic boost from trade with the U.S. That $500 billion deal is good for them, too.
Of course.
But they rely heavily on Russia for defense equipment and cheap energy, so they can't afford to publicly dump Russia.
It would humiliate a key defense partner and maybe spike their energy costs.
Exactly. So they are likely doing what diplomats call constructive ambiguity.
Constructive ambiguity. I love that term.
It's the art of letting everyone hear what they want to hear. India might reduce oil purchases quietly over time, letting the U.S. claim a win while publicly maintaining their neutrality so Russia doesn't cut them off.
It's a win-win economic deal wrapped in a very messy political narrative.
In geopolitics, that's often all you have.
So let's try to pull this all together. It feels like a chaotic morning. We've got software stocks crashing because of AI fears. We've got chip stocks falling because expectations are impossible to meet.
Right.
Pharma is down because the easy growth is over. Commodities are swinging wildly based on who runs the Fed. And global trade is a mix of billion-dollar deals and diplomatic he said, she said.
If there is a theme today, it is disruption anxiety.
Disruption anxiety.
Think about it. Every single story we covered is about a comfortable status quo being upended. The status quo of software always grows is being disrupted by AI. The status quo of pharma monopoly is disrupted by competition.
And the market hates uncertainty.
It despises it. And right now, investors are trying to figure out who the winners are in this new reality, and they are aggressively selling anything that looks like yesterday's winner.
That brings us to our deep dive insight. We always try to leave you with something to chew on, and I can't stop thinking about that Sospocalypse concept. It feels like the biggest shift.
It raises a profound question, doesn't it? If we really are moving to a world where AI agents like that Anthropic tool can do the work of the software and the employee who uses it, what does that mean for the economy?
Yeah. If I don't need the software license and I don't need the junior lawyer to operate the software, where does that value go?
Exactly. Are we looking at a massive recession in the tech and services sector because revenue evaporates and jobs are lost? Or are we looking at the biggest productivity boom in human history, currently disguised as a market crash?
Wow.
Because if the cost of doing legal work drops to zero, the amount of legal work we can do goes to infinity.
That is both exciting and absolutely terrifying. It's the definition of a paradigm shift.
That's the nature of disruption. It destroys the old world to build the new one. We're just living through the demolition phase.
Well, on that slightly existential note, we're going to wrap it up. It's a wild Wednesday, folks. Keep your eyes on those Google earnings after the bell today. They could set the tone for the rest of the week.
And keep an eye on those software stocks. Let's see if the panic selling stabilizes or if this is the start of a real repricing of the entire tech sector.
We will be watching it all for you. Thanks for listening to this deep dive into the market chaos. We'll see you all tomorrow morning with new headlines from major financial magazines.